Style-Based Investing und ich freue mich sehr, dass wir zu diesem Thema Herrn Professor Tobias Moskowitz gewinnen konnten. Herr Professor Moskowitz kommt aus Chicago, unterrichtet dort an der University of Chicago, hat den Pharma Family Shared Professorship dort inne, den Lehrstuhl, der von Professor Pharma gestiftet worden ist, inne. Er ist außerdem Gastprofessor an der renommierten Yale-Universität und er ist nicht nur Wissenschaftler, sondern steht auch mit einem Bein in der Praxis als Berater und Prinzipal bei AQR in Connecticut. Er ist vielfach ausgezeichnet worden für seine Forschungsarbeiten, hat zahlreiche Preise gewonnen. Er wurde unter anderem im Jahr 2007 von der American Finance Association als bester Finanzökonom unter 40 Jahren geehrt. Also auch Professor Moskowitz steckt mitten in seiner Schaffenskraft und wir sind sehr gespannt über Ihre Ausführungen. Professor Moskowitz, the floor is yours.
Okay. So, thank you very much. I'm going to talk a little bit about, well, obviously by the title, style investing is the topic today. As you notice, it looks like I have several jobs. Some days it feels like that. Most days it is one job. And let me talk a bit about my partnership with AQR. I think what I'm going to talk about today is a good example of where academia and practice meet to talk about something that's very hot right now, which is, we call it style-based investing, but you've heard other names: smart beta, factor-based investing, alternative risk premia, all kinds of different names. And really, this is the culmination of 4 decades of academic research being brought into practice and being talked about today in what I think is a very productive way. So let me start with, I'll skip the disclosures. That's the other price of working for firms. Those disclosures have to go up. I don't do that in my academic presentations. But let me mention briefly what the agenda is this morning. First, I want to talk a little bit about what the styles are. For most people in this room, you already know what they are. In fact, the survey results were very consistent with what I would have expected, which is roughly pretty much random variation as to which of those will win out over the next 5 years. But I think most of us in this room have thought about those different styles or factors as having long-term evidence that generate risk premia. So I want to talk a little bit about that as well. I also want to mention some of the facts and fictions regarding these styles, because there are many of them out there and there's much confusion as well. I mean, with popularity and with discussion also comes some confusion. And then I'll talk about how style investing, some of the work I've been doing over the last 5 years, has gone from just the equity space, which is where academia has mostly done most of their research, and what's exploded over the last 5 years is applying these same concepts to fixed income, commodities, currencies, all other kinds of asset classes with some profound results. Okay? And then I'll conclude with what does the future look like, or what might we expect. Okay. So let me start with just going back 50, 60 years. Right? Remember, if you look at the investment landscape a half century ago, everything was alpha, right? We get into this debate all the time in practice. What's alpha? What's beta? Now we have smart beta to distinguish from traditional betas. But these are really just semantics. If you go back 50 years, there were no index funds. There was no notion of a simple beta. Everything you could thought of was alpha. Fast forward a few decades, and with the advent of the S&P 500, with bond indices, with other indices, we suddenly started having this discussion about alpha versus beta. But notice, the way I've drawn this here is the total return space really hasn't changed. What's changed is, of course, what we call traditional risk premia, or our traditional betas, was commoditized, sold at lower fees in a transparent way. That's good news for investors, but it didn't really change the return stream that was out there. And what we're seeing today is the same innovation. Now it's in terms of value, momentum, carry, and defensive or low volatility strategies, and it's being called alternative risk premia, or style-based investing, or smart beta, whatever you want to call it. It's another process that we're packaging the same source of returns but at lower fees in more transparent ways, and talking about it as a different segment. So I just want to sort of start off by saying, look, let's remember that these things have been around for a long time. They're being repackaged in new forms, but they're really the same things that have been there forever. It's just, what we're calling true alpha has changed quite a bit. Okay, now again, I think this is good news for investors. Now, what's in that middle slice there? Okay? That middle slice that we're calling style-based investing or alternative risk premia is really the culmination of a long history of research, going back to the 1960s with the original capital asset pricing model, which launched index funds like the S&P 500, through the work of Fama and French, and the momentum work of Jagadish and Titman, carry strategies, low volatility strategies. You see the timeline here. And by the way, it's a very biased timeline. You'll see a lot of my name up there, but for every one of my papers, there are dozens and dozens of other papers by other academics. But the big ones being Fama and French, and Bill Sharp's work back in the 1960s leading this off, okay? And what are we talking about when we think about this research? Well, let me just show you a couple of simple plots. Again, most of you have seen this. But here, if you just take a look at, this is more updated data. If we just look at US stocks, for instance, which is where most of this research began, if you rank stocks on a simple measure of value, okay, book to price, let's say, sort them into quintiles. This is all from Ken French's website, Standard Academic Evidence. And look at their returns over time from 1951 to 2015. You get this nice, pretty picture here, which is the most expensive stocks, the ones with the lowest book to price, the growth stocks, tend to underperform. They have lower returns relative to the other extreme, at the other end, the cheapest stocks, the high book to price stocks, which tend to give higher average returns. Again, all out of sample. But what I like to see when I see this picture is notice the steady increase, right? As I go from expensive to cheap, I expect to get higher average returns. Now, as we all know, this doesn't work out every single year, but on average, over long periods of time, you get this picture. And when I see a steady increase like that, what does it look like to me? Well, it looks like a beta. As I get more exposure to cheapness and less exposure to expensive, I get an increase in returns. On average, that's what I expect to get, okay? And we see this with every style or factor that we think matters in asset pricing. So we can do this for value. We can do the same picture for momentum. Here, instead of sorting on book to price, I'm sorting based on the past 1 year return, okay? The losers out of sample tend to underperform relative to the winners, okay? Where losers and winners are defined on their past 1 year returns over the previous year. And again, you see this nice linear monotonicity there. As I go from less momentum to more momentum, I expect to get higher average returns, okay? We also see the same thing with carry strategies. Here, instead of equities, we're going to go back to the original work that looked at currencies, right? I go long currencies that have high local interest rates, short currencies that have low local interest rates. And again, out of sample, as I go from the lowest to the highest in terms of carry, the local interest rate, I get a higher expected return and steadily increasing. And then finally, we have something that I'm going to call defensive, which can encompass low beta strategies or low volatility strategies. They're very similar. We'll even throw in other things like quality measures. We'll call that part of defensive as well. But you can see here, I've got two bars plotted. The dark orange here is the annualized risk. So there's no question beta predicts risk. So the highest beta stocks on the left here do tend to predict higher risk. Beta is a good measure of risk versus the low beta stocks on the far right. And then the faint bars there represent the average returns. And you'll notice it's remarkably flat. If anything, the high beta stocks have slightly lower returns than the low beta stocks, just in terms of gross returns. This is the puzzle with the CAPM, that the CAPM, while a great theory, does not explain the data very well. Betas don't line up with average returns very well. And of course, the implication of this is, if I were to buy the low beta stocks and lever them up to the same risk as the high beta stocks, I would get much bigger returns. That's the low beta anomaly, the low volatility anomaly. That is, on a risk-adjusted basis, the low beta or low risk stocks significantly outperform the high risk stocks. And it's fairly monotonic as well. Okay, So from 40 years of academic research, what have we learned? It's very simple. All else equal, cheap stocks outperform expensive stocks. Buy stocks that have done well recently and avoid stocks that have done poorly. All else equal, buy high yield, avoid low yield, and prefer safety over risk. Pretty simple, right? In fact, when I tell this to my friends who aren't in finance, they say, that's all you've done for the last half century? That seems obvious, right? Doesn't that have to work? And of course, as we all know in this room, from a market efficiency standpoint, not necessarily. All those things might affect prices, but not necessarily expected returns. But the evidence is quite overwhelming on all four of these things that they predict expected returns in the long run. And again, quite intuitively. Now, you might ask, what styles am I missing here? One of the ones that always comes up is size. What about the size factor? Don't we believe size is a factor? Certainly the industry has used size as a way to differentiate assets. We have small cap versus large cap. We treat these things differently. Fact of the matter is the evidence on size is much weaker than the other styles, okay? Moreover, the way I think about size is it's really a poor measure of illiquidity, okay? So I do believe that there is an illiquidity factor. I'm not going to talk about it today because I think it's a different animal. I think it manifests itself in things like private equity and other sorts of strategies like that. I think it's real, and I think size is related to that. It's just a poor measure of illiquidity. So we could throw that in there as another factor as well. And then other people will talk about profitability or quality as a more general framework. I do believe that that's a factor. We do believe that's a factor at AQR as well. But we think of it as part of the defensive bucket, that it turns out high profitable stocks, which do give alpha and outperform other factors, they also have very low beta and low volatility, and in fact, they're highly correlated to that defensive bucket. So when I talk about the defensive factor, what I really mean is low beta, low volatility, and things like quality and profitability all lumped together, okay? If you want to separate those two out, we could call them two different factors, but I think they're very much related. And that's going to be important when I talk about, right now we're just talking about equities, but we can apply these concepts outside of the equity space, and there we want sort of a more general definition related to defensive, because I don't know what the profitability of a currency is. It doesn't really make any sense, okay? It's a stock concept, but not necessarily a non-stock concept. All right. Now, the academic evidence suggests that these premia are there, they're in the data, and they're now being harvested in all kinds of simple, accessible forms. But there still remains a lot of facts and, importantly, a lot of fictions associated with these. For instance, most people, when you talk about value and momentum, they think of them as diametrically opposite. You either have to be a value investor or you have to be a momentum investor. You can't be both. Okay? In fact, as a simple example, there are those that follow the trend, which we call momentum investors, and those that deviate from the trend. They're contrarian. And the world sort of thinks of these things as separate. You can't be both at the same time. Okay? But that seems at odds with what we've learned from academic research. It's in fact much better to be both than it is to either be one or the other. Okay? And I'm going to come back to that. And let me focus on value and momentum as kind of two key styles or factors that there's a lot of misconceptions about. And the same applies to the other factors as well. For one, when people talk about value investing, they often say, well, a real value investor has to have conviction, has to hold a concentrated portfolio and a deep value portfolio, really the cheapest stocks, okay? That's, I'm going to show you, false. You can be a value investor in a very well-diversified manner. In addition, when we talk about momentum, people will think of momentum as a much higher turnover, higher frequency type of strategy, and one that's more sporadic and more volatile. And again, I'll show you, it behaves much the same as the other factors, like value, that's just not true, okay? And then something that I'll phrase as a fact is what I mentioned earlier, that in fact, being both is better than being either one alone. The fact is, value and momentum work better, much better, in fact, in combination than they do picking one versus the other. And then, as I said earlier, I'll also show you that these concepts, not just value momentum, but also carry, defensive, they apply outside of equities as well. We can apply them to all kinds of different asset classes and in much the same way. And that's some of the work I've been doing for the last 5 to 7 years, okay? And then I'll finally conclude with what does the future portend? Okay? In other words, what's the risk that these things will disappear? The question you were asked in the survey was, what's going to look better over the next 5 years? And you saw the responses were pretty close to 20% on all 5 of those things, about what you'd expect. Maybe a little less for momentum, a little more for low volatility. But even thinking beyond the next 5 years, what's the risk that any of these things or all of them go away? We'll talk about that. Okay, so let me start with the first fiction. Can value investing really be implemented in a diversified way, or does it have to be positioned in a concentrated portfolio? Well, certainly if you ask Warren Buffett, I've heard his name already, he would say, look, diversification is protection against ignorance. If you know what you're doing, there's very little reason to diversify, okay? Now, I take a lot of issue with what Warren Buffett says, but let's talk about it just with respect to value. We often think of, in fact, Warren Buffett is put up as the poster child for value investing. But that's not what we really mean in academia when we think about value investing. Another way to put this is, look, if I use Warren Buffett as my poster child for value investing, that's akin to using George Burns as my poster child for the benefits of smoking. I don't know if you remember George Burns. Lived to 98 years old, smoked 15 cigars a day for 75 years, okay? The plural of anecdote is not data, right? Warren Buffett is not the quintessential value investor, just as this gentleman, Mr. Burns, was not the quintessential sign for the health benefits of smoking, all right? And in fact, if you think about Buffett, Buffett gives credit to Benjamin Graham, one of his mentors, for teaching him his philosophy of investing. If you look at what Graham actually wrote, it was not the Warren Buffett style of value investing. It was a diversified approach, okay? That a diversified list of value stocks as well as good growth stocks, so value at a reasonable price, is the right portfolio to build, a diversified portfolio, okay? So value investing often gets this misnomer that it's a concentrated, active type of bet, when in fact, a simple diversified factor-based approach is just as valuable, okay? All right, in other words, there's many ways to get value exposure, not just in the concentrated form. Now let's talk a bit about momentum. Momentum, on the flip side, is often positioned as the antithesis of value. Why? Well, we'll see in a second. It's negatively correlated, but that doesn't mean it's totally different, okay? It means it earns its returns at different points in time than value, but it doesn't mean it's the opposite kind of strategy. And one of the things that people often say, typically value investors who say, look, this is the right way to invest, anti-momentum, is they'll say momentum is very sporadic. It trades a lot, which is true. It's got a high turnover, and it's therefore too volatile and too sporadic. But again, let's look at the data and let's see if in fact that's the case. First of all, if you look at the Sharpe ratio, on the left here, I've plotted the annual Sharpe ratio of the market, as well as Fama and French's small minus big, or size factor, their value factor, high minus low, their momentum factor, up minus down, and then a combination of value and momentum at the end there, which is a 60-40 combination of value and momentum. Notice that at least on a Sharpe ratio basis, momentum does better than the other factors, okay? So if it is more volatile, okay, and a lot more volatile, it must be that it's also a lot more profitable. That on a risk-reward basis, it actually does at least as well as the other factors, okay? So even if it was more sporadic or more volatile, you certainly get compensated for that. But notice the bar at the right here, which is the combination of value and momentum. That gives you the biggest Sharpe ratio of all, okay? And again, that's the point I'm going to stress here, which is looking at these factors standalone is somewhat useful. But as an investment process, you want to think about building portfolios that expose you to multiple factors because they interact with each other quite well, value and momentum being one of the chief examples. We can also look to the far right there. We can see, well, when does momentum earn its returns relative to the other factors? Is momentum just one of these strategies, as often people portray? It makes money, big money every now and again, but it loses big money a lot. Again, if you look at the percentage of positive months you get returns on these factors, they're pretty similar and pretty steady, right? Value earns its returns on average about 60% of the time at positive months, certainly over 5-year rolling estimates, and momentum is pretty similar. And a 60-40 combination of value and momentum, similar as well. By the way, you might ask, why is it 60-40 value momentum? Why not 50-50? We have a debate about this. Momentum is slightly more volatile than value, so on an equal risk footing, that's the right combination. But to be honest, it looks the same 50-50. So not much of a difference there. And yet another way that we could look at the risk of momentum and compare it to value, or this idea that momentum might be more volatile or more scary, is to look at drawdowns historically. This is from 1951 through 2014, and you can see here that momentum does have its dark times. In fact, pretty recently, in 2009, the spring of 2009, you can see there in the blue, but look at the purple line as well, that's value. If momentum has scary times, and people call it scary, well then value is downright really scary, right? It looks just as scary as momentum. But again, that misses the point. The point is, in combination, they're both much better. And you can see that here with the blue line. The green line is momentum, the purple is value, but the blue line smooths those out. Okay? That a combination of value and momentum experiences not only a higher Sharpe ratio, which you just saw, but also less severe drawdowns. Okay? And that's going to be an important concept. Okay, so that leads me to the main point here. Value and momentum, rather than being seen as opposite forces and different types of investing, you have to pick one or the other, really should be viewed in combination. Why? Because they're better in combination, right? And this is not only true for value and momentum, it's also true for the other styles as well. So here's a simple example, just looking at equities for now. If I take, on the upper left here, the worst 3-year period for value, we all know when this was. It was at the height of the tech bubble, okay? Or actually, I have the FAMA chair. I'm not allowed to say bubble. Tech boom, all right? You can see that value returned over that period negative 17-18% per year. Okay? It was a disastrous time to be a value investor, right? But notice, momentum during that period was a tremendous winner. Momentum experienced a positive 20% return, would have completely offset your value losses, right? Now, if we throw in another factor, profitability here in blue, or another measure of defensive or quality investing, that also contributed positively. So if you were just a value investor, you bore this risk at the height of the tech boom, okay? And you suffered greatly during it. If, however, you embraced momentum and profitability in addition to value, that is, you thought about the world in a multi-factor sense, you had a pretty decent ride, okay? In fact, you ameliorated those losses on value. The same is true for the other factors. Momentum is going to have its dark times too. Notice, July 2008 through June 2011 was the 3-year worst period for momentum. And you can see it suffered big losses. But during that time, value did well, and profitability did very well. Again, a multi-factor approach really saved the day. And you can do the same thing with profitability. From June 2004 through May 2007, profitability or low volatility or low risk investing was not a great strategy. Momentum contributed somewhat positively, but value was the true winner at that time. Okay? So going back to the initial survey question, when the question is asked, which of these 5 factors is going to do well over the next 5 years? My answer is, I have no idea. Okay? I can promise you, though, that very likely one of those factors will do very badly over the next 5 years. I can also promise you that other factors will do quite well. And if I take a well-diversified average of those 5 factors, I can expect pretty normal performance to what you see. Okay? That's the point. So we spend a lot of time thinking about which factor is going to do well, when in fact the easy answer is a diversified position in all factors is a much better and much safer bet. Okay? That's why I didn't answer the question, by the way. Okay. And you can see why. In the lower right-hand corner, look at those correlations. Taking out the equity market, so in terms of active risk, value and momentum have a negative 0.5 correlation on average. By the way, that's not only true in US stocks, it's true in every market of the world. You do the same thing in Canada, in Germany, in the UK, in Japan. There's a consistent negative 0.5 correlation between value and momentum. Same with profitability. Profitability has a negative correlation to value and a small but positive correlation to momentum. The combination of doing all three of these things because of those low correlations and high average returns is tremendously helpful, okay? And that's the point. And you not only see it on average, as I'm pointing out with these other charts, you see it in the extremes. Not just on average, but even when value is absolutely tanking during the tech bubble, or momentum, which followed the financial crisis and did terrible, you see that those correlations hold true. They don't change that much through time either. Okay. Now, we've talked about equities, and I've mentioned that these concepts apply not just to equities, but much more broadly. So some of the work I've done over the last 5 years has been looking at these concepts in other markets, okay? And here's a summary of some of that work. We know that for stocks and industries, both value and momentum generate positive Sharpe ratios, positive returns. Okay, the purple here is value, the green is momentum. But you can do the same thing, not just for individual equities or industries, but also for picking countries, right? I can rank the UK, Germany, Japan, the US on book to price, aggregate book to price, or on their momentum, and I get very similar returns to what you get for individual stocks. Those concepts work at a country level as well. Why stop there? I can do the same thing with country bonds. Rank the government bonds, fixed income securities, based on value and momentum, and I get the same thing. Now, a good question that you ought to have on your minds is, well, wait a minute, how do I measure those concepts outside of equities, right? In equities, I measure value by book to price or some measure of cash flow to price, fundamentals to market value. Momentum, I measure by sort of past performance. How do I apply those out of sample to other markets? Well, momentum's easy, right? Every asset has a return. So for fixed income, as well as currencies, commodities, I just take the past 1 year return on the assets and rank them, just like I did for equities. That's easy. But what about value? Well, remember, there's nothing special about book to price or fundamental cash flows to market values, right? That's a concept that we use to measure cheapness versus expensiveness, right? The idea being that if a firm has a really low price but really good earnings or really high book value, it looks cheap, okay? We can apply that concept more generally. Think about for bonds. What would be a measure of cheapness for bonds? Well, pretty simply, think about its yield versus inflation, right? The real bond yield is a simple proxy of whether the bond looks cheap today versus expensive. Again, we're talking about government securities. You can apply these concepts in credit as well, adjusting for the risk premium if you want. Okay, we could do that as well. Or take currencies. How would you define cheapness versus expensiveness? Well, think about purchasing power parity, right? The idea is a cup of coffee in Chicago, Illinois ought to cost about the same as a cup of coffee in Geneva, Switzerland. And if you've been to both those places, you know that's definitely not true, okay? But in the long run, that should be true, right? That the cost of goods in the long run, adjusted for interest rates, should converge. So one currency currently looks cheap, one looks expensive. That bet can be made as a value bet. And even for commodities, you can look at things as long-term reversals. Take an average of the long-term spot price on the asset versus what the spot price is today, and look at that from a value perspective. Now, here's what's interesting. Not only do those concepts produce similar returns, in other words, the Sharpe ratio to a value strategy in fixed income or currencies looks pretty similar to what you get in equities, and same with momentum, but some of my research has shown that they're also correlated. In other words, when value does badly in US stocks, it's simultaneously doing badly in international stocks as well as fixed income markets, currencies, and commodities. The good news is the correlations aren't perfect. They're not one, but they're positive and significant, meaning there's what an academic would say is there's common structure. There's common risk associated with value strategies. They move up and down at the same time. Same for momentum. These things are linked. They've been a part of markets, not just equities, but other markets as well for a very long time. Okay. Now, let's continue this concept, not just with value and momentum. Does it also apply to low volatility and carry strategies? Can we apply the same concept? Carry strategies are interesting because they were first discovered in currencies, but we can apply those concepts to fixed income and to commodities and even to equities if we want. In fact, how do you think about carry? Or how do I think about carry? I think about carry as the return you get if markets stay the same. If prices don't move, that's the return I earn. Okay? So for currencies, it's very easy. If the spot exchange rate does not move, I earn the local interest rate. That's what the carry is by definition. For equities, what would be the concept of carry? Well, if prices don't change, what do you earn from buying an equity? The expected dividend yield, right? So that looks like a value strategy, I'll grant you, but that's the concept of carry. In commodities, if the spot price doesn't move, the carry would be the convenience yield curve, right? The futures curve, the slope of the futures curve. And in bonds, it would be the slope of the yield curve. So we can apply those concepts out of sample as well. And this is what you get. First, applying value in all these markets, we know generates a positive Sharpe ratio. By the way, you'll notice in commodities, it didn't work out so great. So what? We don't data mine, right? It still behaves like a value strategy, okay? So it's still correlated with the other markets, just didn't, over this particular time period from 1990 to 2014, didn't perform quite as well, right? If you apply momentum in all those markets, you get pretty steady performance. And we can also apply carry in all those markets. Notice I didn't apply carry for equities here. Why? Because it looks exactly the same as the value strategy. So you could put in the same bars if you want. All right? But you can see carry doesn't just work in currencies. It also works very well in fixed income and in commodities. And then finally, what about defensive? This is low beta. We can apply that concept in fixed income as well. You could use beta with respect to a bond index or even duration as a measure of risk. And again, low-risk fixed income securities outperform high-risk fixed income securities on a risk-adjusted basis. Okay. And of course, the punchline is over to the far right. If you look at the last four bars at the right, you see there's diversification benefits not only across the styles, but here we have diversification benefits within a style across markets. Applying value in all these places simultaneously gets you a more precise value premium than in one market at a time. Same with momentum, same with carry, and same with defensive. Okay? But if I diversify across the styles themselves, I get even more tremendous diversification benefits. A stock portfolio that combines value, momentum, carry, and defensive is way better than the sum of its parts. Same for fixed income, same for currencies, same for commodities. So there's two elements of diversification that we think about today. For a long time, we've known about the diversification benefits of a cross-asset class diversification, right? 100% equity portfolio is not as good as a 60-40 stock bond portfolio, or adding commodities to that, or other asset classes. And then I think the debate on factor-based investing is sometimes misguided. A lot of it is thinking about it in terms of alpha. Which factors will do well? Well, that's not the right concept, in my opinion. That's much harder to do. If you can do it, great, more power to you, but it's a very tough thing to do. But diversification across the factors, that looks tremendous. In fact, those diversification benefits across factors are bigger than the diversification benefits you get across asset classes. And of course, what we ought to do is both. Diversification is, some people call it the only free lunch in finance. It's not exactly free, but it's simple and easy. It's the lowest hanging fruit. And you can see here in terms of factor-based investing, that's the way I think about these concepts, okay, from a diversification perspective, not from a predicting return perspective. Okay. And you can see that right here. Here's the cumulative returns to a value, momentum, carry, and defensive style-based strategy in all these markets over time. They all do well on average, but they do well at different times, right? As you can see, right, there are times when value suffers, times when momentum suffers, times when carry and defensive suffer. But if I put them together and diversify across all those styles, I get a much smoother ride. Okay? It's not perfectly smooth, of course. There's always risk. There's always going to be bad periods, but you mitigate those risks by diversifying. Okay? So the same concept we've learned over the last 50 years in terms of asset allocation, we need to apply to factor-based as well. Okay. And again, if you like numbers more than graphs, these are the correlation numbers. All right? So you can see here that value, momentum, carry, and defensive in a long-short portfolio have 0 to slightly negative correlation, right? Value and momentum have strong negative correlation. The other styles, pretty much 0 correlation, yet they all produce positive returns, okay? So that's going to give you tremendous diversification benefits. Perhaps more importantly to your portfolios today, not only are they uncorrelated to each other, but they have almost 0 correlation to just traditional betas, traditional equity markets, traditional fixed income markets. The correlation of value, momentum, carry, and defensive to a global 60-40 strategy, pretty much 0. Carry has a slight positive one, about 0.28. Okay? And if I take an average of these things in what we call a style premia strategy, so taking a combination of all 4 styles in all these asset classes, that has a correlation of 0 to the 60-40 strategy. 0 to equities alone, almost 0 to bonds, about 0.1 correlation, and 0.05 close to 0 to commodities, on average 0.04. Okay? So you're building a portfolio that's uncorrelated to your current exposures, but has exposure to these other 4 factors and provides tremendous diversification benefits. And that's the idea, that's the concept here. Okay. And because of that, people always ask me, well, this factor-based investing, it works on average, but when doesn't it work, okay? And my answer is, there will always be times when it doesn't work, right? But they're not the same times as the times that traditional equity risk premia don't work. In other words, the risks that traditional portfolios face are different than the risks that these style factors face. Okay? I'll give you an example. Think of value, for instance, as a single factor. It's a good example. When did value suffer its greatest losses? During the height of the tech boom, when equity markets were working tremendously well. Okay? So if you combined those two, that was a pretty good bet still. You lost on value, but you were still relatively happy. But if you do this in the proper way, combining all 4 of these styles, you can see here, let me start up at the top here. If you look at different macroeconomic environments, and I'm going to look at 4 scenarios where the economy is growing and inflation is high, where the economy is growing and inflation is low, where the economy is declining and inflation's up, and when growth is down, when the economy is declining and inflation is down. Now, we understand how those macroeconomic risks affect equities and bonds, pretty simply, right? When the economy is growing, it's good for equities. Sorry. Okay, when the economy is growing, here in the green, it's good for equities. When it's declining, it's bad for equities. When inflation is down, it's good for bonds, okay? And when it's up, it's bad for bonds. And for commodities, it's somewhat mixed, okay? But now look at the style premia, value, momentum, carry, and defensive. The performance is pretty steady in these environments. Sure, value goes up and down a little bit, momentum, pretty steady, carry, defensive, but it's not really facing the same kinds of risks. Now, that isn't to say that value, momentum, carry, and defensive don't have their dark times. They do, but those times aren't during the times when the rest of your portfolio is facing these risks, these macro risks, okay? And to put it more bluntly, at the bottom here, if I look at a global 60-40 stock bond strategy versus a diversified factor-based approach, they face totally different risks. In other words, a global 60-40 portfolio is going to do well when the economy is growing and going to do poorly when the economy is declining. And you might say, well, what about the bond piece? 40% of your dollars are in bonds there. How come that doesn't help mitigate those risks? Well, remember, 60-40 portfolios, it sounds diversified, but on a risk basis, it's 95% equity risk that you're taking. Okay? And why? Because equities are 5 times more volatile than bonds. So even at 40% of my dollars in bonds doesn't really help me that much in terms of a risk. This was the whole idea behind risk parity, for instance, of trying to make that better diversified. But more germane to our discussion here, the value, momentum, carry, and defensive styles not really affected by any of those environments. Their performance is pretty steady, okay? And so a diversified portfolio of those factors gives you a smooth ride. It will have its dark times, but it's not when bonds and equity markets in general are having tough times. Okay. And so just to summarize here, just adding a little bit of factor-based investing to a simple 60-40 stock bond portfolio can already redeem benefits. If I take 60-40 global stocks and bonds here and add just a 10% allocation to value, momentum, carry, and defensive, a style portfolio that's diversified, I can already increase my Sharpe ratio by 40 to 50%. Okay? In other words, I can increase the mean return by about 80 basis points and reduce the volatility of returns by 80 basis points. That seems like, wow, how do I get that? How do I get to increase returns and reduce volatility? By adding something that's uncorrelated with positive returns. Okay? Simple investments 101. Obviously, if I add more to styles, I can reduce that even further. Okay? If I just put a 30% allocation to styles, I've increased my return by 2.5%, decreased my volatility by almost 2%, and obviously that's a much better risk-reward trade-off, much better Sharpe ratio. Okay. So finally, let's spend the last couple of minutes talking about these things. They've been around for 40, 50 years, at least in the academic literature. In the data, by the way, there's evidence for things like value and momentum going back multiple centuries. We have data on momentum back to the 1800s in the US. Momentum's been around well before we even studied these things as a science. They've been a part of markets for a long time. That's also true for value, defensive, and carry as well. Okay? So given that these things have been around so long and we've talked about them so much, they've been in the literature, they've been public information, and now in the last 5 years, many, many investment products have been launched that have gathered a lot of assets. What's the risk that they'll go away? Okay? And this comes down to understanding why they're there in the first place. So whether something is going to be here or not really depends on why it's there in the first place. And the simplest answer, of course, would be it's data mining, right? Suppose it was data mined and it was never really there in the first place. It was a statistical artifact. Well, then you won't expect it to be there in the future. Now, the reason that it took us 40 or 50 years to come up with these things is we've spent a lot of time, and when I say we, I'm talking about the academic community in general. Academics have spent a great deal of time trying to determine which of these factors are robust and real and work out of sample and have good economic stories and which aren't. So although there are, I think the literature's littered with something like 317 published anomalies in finance, most academics will tell you we believe in kind of 4, 5, or 6 that really withstand the true robustness tests. Okay? And that's actually something that academics are focused on quite a bit these days. All right? So let's rule data mining out. We have way too much out-of-sample evidence to believe that these things aren't real. Okay? But can they go away? The short answer is, of course they can. The long answer is, how likely is it? And I think very unlikely. And let's talk about why. First of all, why do these things exist in the first place? One story, an efficient markets view of the world, is that they're compensation for risk. The reason value earns a premium over time is because it's exposed to some risk, albeit a different risk than traditional equity markets or traditional bond markets face, as I just showed, but a risk you get compensated for. Now, does that mean it's going to be there forever? Not necessarily. Risks can change. Tastes for risks can change. The risk premia can change. But it takes a lot to be able to change that. Now, one way to think about these things, of course, is that, remember, other than the market portfolio, everything is a zero-sum game. For every value investor, there has to be a growth investor because everything has to add up to the market. So when I stand up here today and say people should embrace factor investing and be diversified across all these factors, I recognize not everybody can be a factor-based investor. We all can't own value, right? Someone has to be willing to take the other side. Now, in the risk-based world, there's a natural person to hold the other side. People who don't mind bearing the risk of value or momentum or carry or defensive get to earn the premium. People who don't want to bear that risk are happy to compensate those for bearing the risk. In other words, I believe that there are investors out there who say, I get it, but I don't want to bear the risk associated with those factors, and I'm happy to give up those returns. Okay? Who might those be? Well, if you look at the data, retail investors, for instance, don't typically like value stocks or some of these other factors, and they're willing to give up some of that. They're short-term investors. Long-term investors are happy to embrace those risks, much like a liquidity premium story as well, a liquidity risk story, which I alluded to earlier. Okay? So, and there's lots of theories in academia about why value might be delivering returns as compensation for risk, and same with momentum as well. There's also the anti-efficient markets view of the world, which is these things are driven by behavioral phenomena. The fact is that value and growth stocks are mispriced. Value is underpriced, growth is overpriced, momentum stocks are mispriced, and so taking the other side of that bet is profitable, okay? Again, that can also disappear. If people learn that they're making a mistake and correct it, that could disappear. If arbitrage comes in and prices away those mistakes, it can also make it disappear. But how likely is that to occur? Seems very unlikely. We have so much evidence on psychology and behavior that says it's very difficult to overcome those biases and get rid of them, right? In other words, we're human. It's hard to avoid being human. That's not likely to go away. We also know that arbitrage is limited in practice. None of the things that I've talked about here today generate Sharpe ratios of like 2 or 3. We're talking about Sharpe ratios of 0.4 net of fees. That's not an arbitrage. Very far from it. There's a lot of risk associated with that. So again, can this disappear? Yes. Is it likely? Doesn't seem like it. As I said, something like momentum has been around for 2 centuries. It hasn't disappeared yet. It hasn't even gotten weaker since its initial discovery. It's remained pretty consistent through time, okay? So in both cases, risks can change, behavior can change, limits to arbitrage can change. They're very hard to predict, and it would take an awful lot to make these things go away. It's always possible, but it's not very likely. And remember, we're talking about a diversified set of these factors, right? Even if one factor goes up and down because of some of these changes, the chances that all of them, all 5 of them, or all 4 of them disappear at the same time seems very unlikely. Okay. And what if they did? Would it still change your investment philosophy? I would argue not. For instance, take value and momentum. Suppose that the momentum return went to 0. Would I still put it in my portfolio? Absolutely. Why? Because as long as the value premium stays the same, momentum is still valuable as a diversifier. So this chart shows you what the optimal weight on momentum is even for different levels of its return, okay? Its historical return is right here, and that would be the optimal weight, okay, about 40%, a little bit less than that. But even if the return on momentum went to 0, you would still put 22% of your portfolio in momentum if you're a value investor. And that's because of the negative correlation, right? Negatively correlated returns with, negatively correlated returns that have a 0 risk premium are still valuable, okay? Now, do I believe it's a 0 premium going forward? No. Do I believe it's as high as this? Probably not. It's probably somewhere in between here. And that's probably true for all these factors. Okay. So, finally, this is where sort of the, my work with AQR comes in. I can talk about the academic evidence, and I know a lot about it, and I've tried to contribute to that literature. Putting this into practice, while simple in concept, is difficult in implementation. So the art of doing this in the best way to diversify your portfolio is what I learned from my AQR colleagues, and that's a discussion for another day. But I'm happy to entertain any questions about that or anything else with regard to style-based investing. So thank you.
Thank you very much, Professor Moskowitz, for interesting presentation. So, ladies and gentlemen, we have about 5 minutes for questions. Wer möchte von Ihnen? So, then I would like to start. For value investors, it has been a very tough time after the financial crisis since 2008. So, what's your particular explanation? Why did value do not perform so well over the last 8 years? And you said you can't predict style returns, but maybe you have a comment about future return for value investors in particular.
Yeah, no, this question comes up all the time. By the way, when I said you can't, I meant I can't predict values returns. Some other people may have other measures that they use. But I think, you know, what you've seen in value, so here's one perspective. What you've seen over the last year for value is pretty similar to what you've seen historically. There will be decades, you know, periods as long as a decade, where any of these risk factors will have a bad run. Okay? In fact, the bad run for value in the last 8 years wasn't even close to as bad as it was in the 90s. Okay? And back in the 90s, when I was working on my dissertation, I heard all the same stories. Value's dead. it's gone, and then what happened? Well, the next decade was one of the best runs for value ever. Now, I don't know that that's going to happen in the future, but at least my best guess is that the value premium is going to look every bit as good as it has historically. I just don't know whether that'll be the next 5 years or the 5 years after that. Now, we can understand a little bit ex post why value has suffered. And if you look at the kinds of stocks that have suffered after the crisis, it makes sense. That cheap stocks have gone out of favor. They haven't done particularly well over the last 8 years. People have been enamored, at least initially, right after the crisis, with low volatility stocks. They gained momentum, then momentum came in favor a little bit after having a tough time coming out of the crisis. Those are all things related to the correlations I put up. So if you look at this from a multi-factor perspective, the performance of an average of all 5 of these factors looks very good over the last 8 years. But if you look at any single factor, you can certainly find one that does poorly. Value was that candidate this time. Over the next 8 years, it will be something else. I wish I could tell you what that is, but I won't know. I just know it'll probably be one of those. So.
Thank you. Haben wir noch eine Frage aus dem Publikum an Professor Moskowitz? So I think we could do it in the break then.
Well, I'll be around in the break if people have questions. I should also mention my colleagues, Chris Palazzolo and Axel Weiss, are here as well if you have questions about the implementation stuff, which is definitely out of my realm. So thank you.
Vielen Dank.